So now we'll have a panel discussion on topic optimizing input tax credit in GST, strategies and insights. Allow us a moment while we set the stage for panel discussion. Meanwhile, let me invite all our panel speakers. We have Mr. Manish Arora, who is the Head of Indirect Tax and GST at Raymond Limited. Simachal Mohanty, Head of Global Taxation at Dr. Reddy's Laboratories. Nitin Goyal, Senior Vice President, Group Indirect Tax Head at Welspun Group. Divyang Thakker, Global Head, Direct and Indirect Taxation at PI Industries. And Rakesh Dubey, Founder and Director at TaxGenie. And this elite panel will be moderated by Mr. Abdulla Pettiwala, who is the Head of Tax at HDFC Ergo. With this, can we have a huge round of applause for all our panel speakers?
Given is ITC, a wonderful topic that we all love to talk about. So, optimization of ITC, I would say, is a little of a misnomer. You can optimize something which is, sort of stuck in a process or something. In my view, ITC is basically a fact. Okay, whether you have an input or you don't have an input, it's basically a binary thing. The optimization that needs to be done is more about the processes governing the ITC rather than the ITC itself. So, I have just had a few points which I have discussed with the panel members, and it's very less of me speaking and more about them to speak. So I'll just nudge them on a few pointers, and they'll share their experiences, and hopefully, the wait for lunch won't be that boring. So, I would just like to put a thought forward. Okay, what would be the effective strategies that one should navigate to sort of maximize the ITC efficiency? So please, anybody can start off and then we'll move forward.
So basically, first we have to understand what is the purpose of this entire theme, that is optimization of ITC. The first thing, when you talk about optimization of ITC, it is kind of, ITC is an asset sitting in the books, how to optimize. First of all, why ITC accumulation happens, that leads to optimization. So in my view, there are three kind of reasons why ITC accumulation happens. One, when the company goes on a kind of growth mode, that is, it adds capex, it kind of strategizes having the finished goods so that when the customer comes, right in the time delivers. This is one of the reasons, capex and the inventory. The second thing is the inverted duty structure, where the input tax is more than the output tax. The third reason is head office, whatever the services are there, that get cross-charged to various units or various states. In my view, these three are the reasons. Then what happens exactly? What is the consequence of this? In some of the states where the manufacturing and supply happens, in those states, there is a ITC accumulation. In other states, where these two functions are not there largely, you'll see there is a cash outflow happens, especially where the products are kind of, traded products are there in some states where the margins are high. There the cash outflow happens, whereas here in these states, the ITC accumulation happens. So this is the fundamental reason why there is a mismatch, and this is the fundamental reason why we are discussing the ITC accumulation vis-a-vis optimization. And then how we optimize that. One, we have to patiently wait for the product to commercialize. If some plants were gone on a very, very high capex mode, we have to patiently wait for the product to get commercialized so that when the product sale, ITC gets automatically liquidated. That is one of the way. The other way is kind of shifting of the product. Suppose there are high value products are there in a location which warrants cash payment. Those products can be shifted to the manufacturing location where there is a sufficient ITCs there so that the cash payment is avoided. And third model is kind of bill to ship to arrangement, provided we satisfy proviso 2 to rule 28, where the input credit is seamlessly availed. That strategy is also adapted. So this is the fundamental of ITC accumulation and what are the steps taken.
Great. Anybody else would want to share something?
See, I am from the manufacturing background. what Simachal told me very practical for all of the businesses to have a ITC accumulation, or vis-a-vis there is a situation wherein we are having a cash outflow. So in my domain, I am facing both these challenges. So what we are doing, we are selling the product from a state wherein we are having an ITC balance and doing a stock transfers which is on the cost from one state to another to minimize the cash impact. And also the ITC liquidation happens with a 100% pace because there is always a markup between the your transfer value and the selling value. And also we are approaching to find a solution for getting the immediate resolution on the inverted duty refunds. And we are also successful in that also. So these two aspects we are following, and also BTST is the major key to resolve the ITC accumulation and the earliest liquidation. Thank you.
So ITC is the direct, like your working capital. Yeah. So obviously you want to maximize that working capital so that, CFO is happy from that point of view. Now ITC comes with the 16.4.2b, these are the 4 criteria. So that means basically, even though money is there, you can see the money in a 2b, but you can't take it unless until all these criteria is taken place. Now you have the AP department which is given strict instruction from the taxation that you can only take when the billing is booked. Okay. Now this is the where I see the optimization, where the process inefficiency in between the your booking and actually maybe goods or service is already received, but it's not booked. And that gap is the immediate, you can say, quick win, from the ITC point. Because as a tax genie, we are working with the number of company. What we see, that is the sort of black hole immediately we see. That's the number one. Number two, if you look at from your vendor side, because other side is they had not declared. And most of the time we saw the declaration, I think we had number of sessions, it's just because of negative cash flow. Because now the vendor has to pay whatever, they declare. Because once they create electronic invoice, then immediately that comes as a liability. They have problem that, you're not going to pay or you may delay because of your booking process. But their liability or the cash is already going, So how we can actually work with the vendor to make the negative cash maybe, whatever terms with the finance, whatever way. So I see the one is the quick win where identify the area where process efficiency can bring the money. The second one, I'd work with the vendor because you cannot keep on, penalizing your vendor, you're not filing without giving the proper solution, So these two areas I see is the quick win.
Okay.
Yeah.
Yeah. So to add to Rakeshji's point, so in fact, this is something which we had been doing in our group. So a very practical solution where on a monthly basis, the tax compliance teams runs the ITC mismatches. So now there is a long list of transactions which is transactions in 2B but not in PR. So there we have given a threshold to our compliance teams that generally we can assume a period between 1 to 2 months, that say if a transaction was reported by the vendor on 1st of April, so in all probability that should get booked in my systems by 31st of May. If there are transactions more than 2 months aging appearing over there, that is a clear red flag. Because, and even that becomes one is the ITC optimization part. The other part is it becomes a control risk for the CFO as well, being a listed company, that look how there are transactions which have been reported by the vendors but which are not getting accounted for in my books even after 2 months. So this is one thing which we have done within our group. Secondly, from a ITC perspective, I think at the CapEx stage, it is because when you look at the whole section 17(5)(b), all of us are pretty aware about the kind of restrictions which are there. But at the capex stage, especially on the civil contracts, how do you structure your civil contracts? So that brings some sort of an efficiency when you are setting up the plant. So like we have a practice that say, when we give civil contracts for our plant construction, so there are split contracts which are given, one for factory construction and one for foundation support for plant and machinery, so that we have a clear identification from day one that which is the tax category for the PO. Even at times what can happen that since we are ourselves into a steel business as well, say if you are setting up a plant, you may buy structural steel in bulk. Now to a particular civil contractor, you are issuing a structural steel. So how do you make sure that what is the quantum of structural steel which has been used in the foundation support? So there also what we do typically, we have chartered engineer certificate certifying that what is the quantity of structural steel which was used in the foundation support, and based on that we take the credits. Thirdly, from a larger point, as my friend mentioned, that especially on the capex stage, there is always a accumulation of credits in some of the locations. So this is a proposal which lot of industry associations had given to CBIC, that at least on the IGST part and the CGST part, they should allow transfer of credits from one location to another location. So at least that thought has been put in the minds of the regulators. So let's see if it happens 2 or 3 years down the lines, because the whole perspective which was given to them that look, for me as an industry, say if I have an accumulation of 100 crores, if I am able to utilize that, I am going to reinvest that 100 crores in the business, which is going to further the government objective. So there is no downside per se in that.
Anyone
Just to add to what all panelists have been saying, I think most of the points have already been covered, but I would just want to add that there are two angles to look at the optimization of ITC. One is the strategy side and another is the process side. Strategy side is where you have to take decisions on how do you want to use ITC lying in one particular state and utilize it. Say for example, stock transfer of your own products to some other location. Apart from that, from the process side, if you want to understand, you need to understand how does the ITC get generated into your organization. Say for example, in many cases we have seen that huge ITC gets accumulated because of imports made at a particular location. And then the goods being supplied to your depots at various locations across India. And therefore, again, you need to understand where your inputs are coming, where your ITC is coming from, whether it is from normal domestic inputs, whether it is imports, whether it is capital goods, whether it is RCM, now ISD as well, from internally generated, either internally generated services to cross-charged or the third-party invoices being that ITC being circulated through ISD. So you need to understand all these angles and then look at how you can optimally reconcile these amounts with your 2B and then optimize your ITC.
Well, nice. So net, if we can summarize to what each of the points lead to, is basically the need for strong documentation. It ultimately boils down to having the right documentation at the right place, and then probably things would be a little more easy to maximize it. Keeping the documentation point in mind, okay, and considering IMS is now a fact, it's a regulatory fact, whether we like it, we don't like it, whatever we need to say about it. So now if we are saying that IMS being a fact, so you have an IMS to a 2B and then you have a 3B, or else your 3B just won't be there and the ITC will not be there. Would documentation be eased out, or will it be more smooth due to IMS, or would it be like otherwise? What are your views?
See, the accounting of the document is the first and foremost priority. As Nitin ji said, they have kept a control of 2 months. And IMS will be reflected, the invoices in the IMS will be reflected on the day of the filing of the GST returns by the supplier or goods service provider. So the accounting of invoices is the first and foremost challenge which we have to overcome. Otherwise, the whole of the system will go on a toss, and we have to keep that pending till the time we book the invoices.
Okay.
So, as our subject is optimization, so look at this way. Government already given you exactly, like how much money they got from the counterparty, and you have the processes are there. Your process has to be tightly integrated and also optimized. When I say optimize in the sense, end of the day, in e-invoice, if your vendor is electronic invoice or otherwise, because OCR is getting better and better, you have the basically HS code, SAC and all sort of thing. You have to start thinking about what that mean from my GL accounting purpose, because you have the purchase order. If you have the purchase order, you know exactly where I'm going to land this, in my GL. That's not a problem. You have to attach the GL and things will happen. Only thing you need to get the GRN or SRN, which confirm, liability is moving to you. Wherever there is no PO, that means basically you have to decodify the whole GL stuff. See, the information is there and machine is getting powerful as we go. Now decode to your business and think about the optimizing. Again, I'm using the same word. If money is there, only thing you should miss is if the goods or service time of supply is missing.
Right.
Or otherwise, that money has to reach to your, the bank. That's it. That's how I see it.
Okay.
As Rakesh ji said, it is a big blow on our working capital if we delay ITC. So basically, IMS is going to help us in maybe encashing it early. And yeah, the documentation, like for example, the credit note stuff and the post-sale discount is something which we all have been grappling with. They have come out with rules which say that you need to get a CS certificate or a declaration, but I think after IMS that should become seamless.
Okay. Yeah.
So in terms of IMS, how we are looking at it is that the government has clearly indicated that it is currently optional while they have introduced the amendments in the GST law. So we are using this opportunity to see that what are the kind of gaps or system changes which are required at our end, as also what are the functionalities which should be there in IMS, so that time to time it can be represented either through forums or people like Rakesh ji. And the government is that way very much interested in making those changes, because once it becomes mandatory, then it becomes more of a post facto kind of a thesis, and then we would again be hounded by notices on ITC. So that's the approach we are taking. We are taking a pretty cautious approach rather than migrating to IMS at this point.
Okay. So basically what we are saying is we are moving more towards an active role of tech and automation to manage ITC. That is effectively what we are saying is the way forward. Just a thought, I mean, it's a thought which just came to my mind. I thought probably, I'll share it. Would it be time to look at the fact that instead of a tax function or a tax, leader being the last point in the entire chain, if that IMS becomes the starting point for the accounting entry, maybe the concept itself needs a relook. What are your views on it?
Yeah.
Yeah.
It's a favorite one, tax was always downstream syndrome, am I right? So even though you don't own any process, nothing, but you are the one who will answer to everyone.
Absolutely.
Yeah. So see, the exactly that is the solution. Can we move from downstream to upstream?
Absolutely.
Yeah. Now, see, if you know the end game, you're the best person who understands the end game. You know exactly where it's going. You're the best person who can design the upstream. Yeah. And if you look at India is the only country where like all the data not only is machine readable, what we call JSON, but you can decodify the component of the information which you require at the end game. And that's actually what we need, and that's where we as a company, as a product company, we focus on that part, because I think if you bring all the knowledge of downstream into the upstream and you stop the challenges at the upstream itself and you communicate to your vendor upstream, because he also pay the liability, am I right, to the government. Now he can actually do reimbursement, whatever is required. And with the IMS and with the e-invoice coming, even before he filed GSTR1, still you can communicate. So at least you can take care of that liability, like, I think that is the biggest thing what we can bring.
But I think the volume of invoices of most of the big ticket companies will affect this implementation.
I mean, currently, if you see, the invoices are anyway accounted, and then the tax person sits to reconcile with IMS. Why can't the IMS be the feeder to decide which invoices have come in? Let the accounts or the finance team or the payments team take care whether received, or probably, in case of manufacturing, the factory guy take care, yes, this has been received, and then the flow happens.
Can I just add your point, Manish? See what happened. I always tell people, look at the airport security stuff. Yeah. So think about, like, you might be getting 100,000 plus invoices per month. Think about, if everything is right, let it go. Yeah. Let it pass. Only you take care of the exception. If you create the very strong exception model at upstream, now you're not taking care of 100,000. You might be taking care of 1,000 exception. That is manageable. It's just changing the process. I need to check everything. To the changing the process, I need to only take care of the exception. And that's the one way I see, things are moving.
So one thing we have to be mindful, before an invoice is accounted, there are various processes are there. Like the GRN has to be done, like the quality check has to be done. So all these process happens, and after that invoice is accepted and accounted. Otherwise that gets into deviation, and so many people are contacted, gets rectified only after that invoice is accounted. Right. In my view, IMS can only be a reference point.
Absolutely.
But I don't think it can be reverse way. You can go to IMS and then come to invoice accounting.
Okay, so the point was, I am saying that whenever the checks happen, just before accounting, the IMS is referred, because all this would also take around a month. By that time, IMS would be uploaded. So you have that line item already there. Now, once if everything is fine, right, then it can just go through basis the IMS, and only when there is an exception should it, raise a red flag.
Absolutely. So that's why I told IMS can be a reference point.
Absolutely.
But not the sole point reversing the entire order.
Yeah, to some extent, I appreciate the euphoria that you guys have in reversing, but again, we'll have to be cautious to see to it, like Simachal said, that we could have that as a reference point. The sanctity of IMS itself needs to be looked into before we change the whole thing. So
yeah, but the thought process needs to start off for the change to be acceptable when it is actually needed to be done.
Yeah, just I want to add, see, these are two parts. IMS is your confirmation of liability taking in. That's basically going through all 16(2)B, all the four things. You can only say yes if your accounting happens. So GRN and everything happen. Then only you can say. Absolutely. There is an electronic invoice which is there for the accounting. So let's not mix the two things. You are actually accounting electronic invoice as a data, and you're confirming to your book and government same time.
Absolutely.
Now, that's what I was saying, bring all the downstream knowledge to upstream, decodified the whole accounting, your book and the government book is the confirmed same time.
Yeah.
Sort of thing.
It is like reversing the batting order in a cricket team, actually.
Yes. That's what I
Pass
mean.
the number 9 to bat in number 1. So I don't know.
But sometimes it does work wonders. Okay, so I think we don't have much time. One last question, okay, that also has suddenly come to my mind. Um, let's, go a little into the future, assuming IMS has stabilized and everything is done, you are confirming everything, things are happening as they should happen. How good or bad would it be if that same information is then used by the direct tax authorities to determine your expenses and your P&L and your trading account?
It's going to happen anyway.
I know.
Yeah.
So I'm just saying,
there is a
let's have a look at it. What are your views?
Even today also our auditors are reconciling the turnover, what is in the indirect tax or GST with the financial turnover.
That's on totality basis. Now we are talking line-wise reconciliation.
We are operating on a 28 or 30 states in pan-India. Every state turnover can be clubbed and then final number have to be arrived as per the financial annual balance sheet. That sort of reconciliation we are giving as of now.
So how would the provisions in accounts be taken care of once this happens?
It's a bit scary stuff, but
But it's going to be a reality.
it's going to happen. It's
going to
a
be a
black and
reality.
white, yeah. Now you have to look at the P&L point of view, and when you look at the P&L, your turnover, if you look at the turnover is you're already declaring, even all the, if you look at the section 5 of 9, GST and 9, you are declaring which is non-GST anyway.
Absolutely.
Yeah? So you have the section 4 and you have the section 5. Yeah, section 5 already take care of all the non-GST. Then you have your turnover. So that turnover is nothing but your revenue side. Now, if you look at the section 6, 7, 8, and then you have all the expense and all sort of thing which you have to declare 9C. What is left from the income tax? I don't know, capital. Like now capital section 42, 43, and all sort of thing you're doing. So now that will go to your asset anyway, So now actually I want to understand what is the left into P&L which they cannot produce your own P&L from the GST data itself.
Absolutely. But they've not actively done it.
It's like they will do
matter of
it.
time.
Yeah, it's just matter of time or no, just provision and few more stuff is there.
Absolutely. Yeah. You want to?
Yeah, I think.
Yeah, no, it's fair enough.
So I want to share one experience, recent experience of GST audit. So the officer, they asked me, please furnish us product-wise cost audit report, which gives the sales, which gives the input, which gives the other cost, and how the cost is traveling to the sales line and what is the profit. That is product-wise. And what is the purpose of this? The turnover and the consumption, they want to reconcile with my financials, they want to reconcile with my tax return 3CD. So by doing this three-way reconciliation, they can find out whether anything that has been destroyed which is not reported in 17.5. So that is the purpose. But the kind of marathon exercise, getting into product-wise cost audit report and reconciling that with 3CD vis-a-vis annual return, it was a mammoth ask. And that is how it is going to happen in future. I'm able to foresee.
Absolutely.
So in a lighter vein, 5 to 7 years earlier, we used to wonder why the government is not automating the tax processes. And now the government they have automated at such a pace that now when we have to submit the IMS data, we try to preempt that, look, they already have an analytics module ready. The moment I submit this data, what is the notice which is going to come to me?
Absolutely.
So probably we need to increase our automation levels as an industry to keep pace with the government.
Great. So anybody else or we wind up? I think.
We can, if there are any questions.
Any questions? There are quite a few people who actually are delaying lunch, so I think might as well take the questions.
Thank you. At the outset, I think I'm going to thank the panelists. It was a great discussion to understand the optimization on ITC. I have a very question, specific, very simple question. See, as a business continuity, we will continue to have credit notes, basis the schemes which we announce. And a practical situation which could happen in FMCG or in auto industry, we issue credit notes as per the business process, maybe on 31st or 30th of the particular month. And the transaction is between two listed companies. And as a process, there is always a fast close process where every company has to complete the MIS and accounting on time. But I do issue a credit note. The receiver receives the credit note. There is a process they need to validate at their end as per the internal process, and they account the credit note on the 2nd of the following month. In IMS, I will report in my GSTR1. The receiver will get reflected in the IMS. Now he has to take action, either he has to reject or accept. There is no other option, and he has to take that action also within the particular stipulated period of 30 days. If the receiver of the credit note rejects, I might have to enhance my liability. But till the time I have to take an action, it becomes it's a complex situation where while the receiver is going to accept, it was bound to accept, but he is unable to accept because he has accounted the credit note in the 2nd of the following month. In that situation, there could be a challenge from an ITC claim. How do we, optimize such situation? Because one solution which we as a industry, we are saying that we are advocating or, counseling our vendor supply partners, our customers to take giving them all the conditions or the situation, business situation, and what action they should take. But this is something maybe as a panelist, as an expert, you can advise what we should follow. And if required, maybe how we can take this advocacy to government so that they support business and make things easy for us to implement. Thank you.
Okay, so you'll take it?
Yeah. So this was the very heated discussion we had with Mr. Sinha, who is the CEO of GST and is a credit note. Exactly what you said. See, everything is about working capital, am I right? Because if I'm doing credit note, that means I'm reducing this one, and also I'm reducing the counterparty, and even though everything is right, he is not accepting that, means he's continuing that money, am I right? From that point. See, the government point of view is the business is done between the two parties. You should have the good relationship. We are just providing the platform. Their mindset is this one. And then if you are basically the partner, business partner, you should talk with them and sort it out. Because see, if you look at from the government point of view, it's just platform, am I right? Where the acceptance of the things is happening. It's a business as usual, And now the biggest challenge is basically only they are doing the accept and reject. That means, and most of the time pending in the sense more or less rejected. That means I'm not reducing my, like this one. Default is other way around also, deem is accepted. If you look at other way around from the customer point of view, you have the deem acceptance. That means someone other way they raise the credit note in between and you don't know, and then your ITC is. So the stand what government had out, GST and had taken, we are providing a platform. It's between the business, how you want to interact and get the thing. That's what was the last time. We asked more and our industry is moving to that one. But still that is where they are standing at this moment, as per today.
Great. So I think we should wind up. Any questions, we'll take it during lunch, I think.
So I'll request you all to please get in touch with our panel members and our moderator offline. We will have them around outside in the lunch. Thank you so much to our panel members and our moderator for such great insights shared.